In this week's video, we'll step outside the CCM Big Four and look at numerous charts that help us answer the question, how much support remains for the bullish case? This is a slide from last week's video. It still applies. We still have somewhat of an indecisive market. We noted last week that our rules wouldn't allow us to do too many things on the bearish front as long as the slope of the S&P 500's 50-day moving average was positive, as it was a week ago. As of the close on September 6th, Friday, it is still positive. The Dow is still roughly flat, and the Nasdaq's 50-day is clearly positive. So where we are, even though we saw incremental improvement this week, and we did take an incremental step back towards risk in line with that improvement, we're still in that potential whipsaw area where the market is still undecided. If you looked at charts on Friday, we had what's known as a doji candlestick, which shows indecisiveness. The market closed well off of its highs and well off of its lows. Here's the lineup card for this week's video. We're going to look at a DeMark chart for the S&P 500, current readings on the CCM market model, market breadth, moving averages on the S&P 500 daily, weekly, and monthly, stocks versus bonds, toothpaste versus Tommy Hilfiger, and we'll check in on the weekly trend in small caps. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. This is a daily DeMark chart for the S&P 500 index. DeMark charts and indicators are proprietary tools from Market Studies, LLC. Those of you that have watched our videos in the past or are familiar with DeMark, you know that a 9 paired with a 13 can signal trend exhaustion. I want to point out that we have a standard sequential count that is on what's known as a deferred 13. These asterisks here tell us that the 13 is being deferred. Why is it being deferred? You need the market to come up into the closing area of the 8 bar here. The closing price on July 22nd of this year was $16.95 and change. So in order for this deferred 13 to show up and no longer be deferred, the S&P 500 would have to revisit 1695.53. We also have DeMark propulsion relative to momentum. A downside target here at 1623 and change. You'll notice this upside target in teal has been here for quite some time, 1732 and change on the S&P 500. So there's 2 reasons on this chart to keep an open mind about potential upside. Doesn't mean that we have to get the 13. We already have active 913 counts. If the sequential count plays out, it points to the potential for more upside. In last week's video, we noted that a lot of the charts took somewhat of a glass half empty approach. And we pointed out that the models told us there were still some positive things in the market. The CCM correlation model, which looks exclusively at weekly charts, closed last week on the 30th on Friday with a 19, which said roughly 81% of the things it monitors leaned bearish. We've had some significant improvement in the last week. We're up to a 42. But the 42 tells us that we still have a market that's hesitant, and 58% of the hurdles or binary answers are still coming back with a concerning no, or the hurdle hasn't been crossed. This is the faster of the 2 highest weighted models. This is one of the sub-models used in the CCM market model. This is the glass half empty one. Let's look at the glass half full. We said the previous model, the correlation model, tended to be the faster of the 2 primary submodels. This one is a little bit slower. You can see it has improved this week as well. Both of them are on a scale of 0 to 100. Last Friday, the market risk model, which is a submodel of the master market model, closed with a 60. This week, it improved incrementally up to a 75. So when we get to the master market model spreadsheet, you can see that we're still have somewhat of a balanced approach based upon the two major submodels that carry the heaviest weights. This is the master market model spreadsheet in terms of the recommended allocation for our time frames and risk tolerance from a base model perspective. Yours may vary. Last Friday, it was at a 45% risk exposure here with a 55% allocation to conservative assets. We've seen observable incremental improvement over the last week. Now we're up to a 62% exposure with a 38% balance in conservative assets. We did take an incremental step back, and we will have closed on Friday right in line with what the models are suggesting. We may be a tad lower than that, but we're very, very close within striking distance. We update the final numbers after the close and make the trades before the market closes. What are these numbers telling us? We're going to look at some charts this week that tend to be glass half full, and there has to be positives out there for this to be at 62. The 38 tells you there are concerns, and the fact that midweek we were at roughly a 50-50 split, this also tells you that the market is fragile here. And if we get prices that remain below 50-day moving averages and we get 50-day moving averages that roll over, we're not out of the woods here. We've seen some incremental improvement, but we could also see some incremental deterioration. So we have to keep an open mind and remain flexible. The models incrementally increase our exposure to risk in line with the improvement that we saw in the technicals and the binary questions this week. It doesn't mean that we won't migrate back in this direction if the bears pick up some steam. The CCM market model uses daily, weekly, and monthly charts to get different reads on the markets from a different perspective. This is a monthly chart of the S&P 500. It uses the 3-month exponential moving average relative to the 10-month exponential moving average. The point of the exercise is basically a trend following exercise. A bearish look, as we're familiar with, is price below both moving averages, and the slopes of the moving averages are negative, and blue is below red. Mirror image is bullish from a trend perspective. Price above both moving averages, blue above red here with a bullish moving average crossover, and positive slopes. Bearish cross, bad things happen. Bullish cross, for the most part, good things happen. Point of the exercise today is this chart, from a long-term perspective, still has a bullish bias. Blue above red, slopes of both moving averages up. And you can see here that price, as of the close on Friday, September 6th, was still above the blue moving average as well. The way the models use this chart and all of these charts is as long as it has a bullish bias, you pay attention. When it starts to roll over, different things can happen. You start to subtract points when the blue turns down, subtract points when the red turns down, subtract points when price goes below. It's an incremental model. As the markets deteriorate, it incrementally subtracts points and it adds points when the markets are improving. In terms of getting potential whipsaws when you have somewhat of a mixed market profile, it's important to remember that the rules take that into account, and in real life, using technicals and when back testing these models going back to 2002, you do see some whipsaws when you have slopes of 50-day moving averages flat. It's part of following the rules, and the whipsaws are taken into account here and baked into these numbers. Could we see some whipsaws next week? Absolutely, positively, yes. But you have to follow the rules. And when the market shows us incremental improvement, we have to increase our allocation accordingly. If we have to adjust the other way, happy to do it. This is a weekly chart of the S&P 500 used in another one of the sub-models, the CCM market risk model. Two of the questions, binary questions, that can be answered objectively with a yes or no answer. There's no subjectivity in answering the questions, no bias or opinions involved. Two of the questions: is price above the 22-week moving average? And you can see typically good things tend to happen when price is above the 22-week moving average. And the second question is the slope of the 22-week moving average positive or bullish? You can see here it never really rolled over and the market righted itself. Conversely, here and here it did roll over and bad things happened. This is a weekly version of the summation index where I have the cursor. It's a measure of market breadth. Healthy rallies have broad participation, a high percentage of stocks participating in the rally. Point of the exercise: the summation index is used in one of our sub-models, the bull market sustainability index. It doesn't carry a heavy weight in the models, but it's used in the models. And why it's used is it can be helpful. All things being equal, when the summation index turns up from low levels, it increases the probability of a sustainable rally in the S&P 500. You can see we're trying to turn up here from a low level. You may notice in the following chart there's a typo. We're aware of it. Just want to let you know that we're also aware that details matter in the markets. This is another risk-on, risk-off ratio used in the CCM market model. This carries a relatively low weight because it's not as helpful or highly correlated to the S&P 500 as some of the other tools we have. However, it can be helpful. We're looking at consumer discretionary, XLY, relative to consumer staples. You can think of this somewhat as toothpaste versus Tommy Hilfiger, or risk-on versus risk-off. Point of the exercise: when the ratio is rising, all things being equal, it's good for the stock market typically. Here you get a bullish moving average crossover with a bullish look. S&P 500 does well in 2009. Bullish cross, bullish look. Stocks rally for quite some time. Bullish, a little bit of a rally. Again, carries a lower weight in the models because the correlation is lower to the S&P 500. It doesn't work as well, but it can be helpful. Currently, it's leaning towards the bullish end of the spectrum, with blue above red, the slopes up, and price above both moving averages. We also have momentum in overbought territory, and typically for all of these ratios, when your Williams percent R and other momentum indicators are in overbought territory, not too many bad things happen. It's when they fall out of overbought territory that bad things tend to happen in the ratios and the stock market. We're looking at a weekly risk-on, risk-off chart, one of the CCM Big Four charts used in the CCM market model. We're looking at S&P 500 risk-on relative to the aggregate bond fund ETF AGG, or risk-off. This is what risk-on looks like when the ratios are rising. This is what risk-off looks like. You can see down here, risk-off, S&P weak, risk-off, S&P weak. Current is a mixed bag. We do have improvement. You'll notice this is the first time that the ratio has climbed above both moving averages on a closing basis since the ratio peaked here. That's improvement. We also have incremental improvement that in the present day, the slope of the blue and red moving averages have turned back up. The only thing that has not happened yet is the bullish moving average crossover. You can see here we're very close, but it hasn't happened yet. So somewhat of a mixed but improving situation Here, we need to see some follow-through and a bullish moving average crossover for this to become more meaningful. But there is observable incremental improvement that took place on this chart this week. One of the long positions that we've been holding is small caps. This is one version of small caps, IWM. There's also IJR and a host of other ways to gain exposure to small caps. Point of the exercise still is in the good things happen look, blue above red, price above both moving averages, and the slopes up. One concern would be momentum looks a little bit tepid here and here with RSI. We'd like to see that pick up. But from a price perspective, there's no real alarming look here yet on small caps, and this is why we continue to hold them. This is a daily chart of the S&P 500 index. These are moving averages that we use in the CCM market model. We've got a component of the model called an override model that uses common sense components like moving averages. You can see we have somewhat of a mixed bag here. Typically not too many bad things happen when the green 50-day moving average still has a positive slope. You can see it flattened out here, but then quickly regained a positive slope again. Here, when it rolls over, bad things can happen. Currently, the 50-day has a bullish, upward sloping bias. However, the shorter term EMA 20 and EMA 40 are still dealing with negative slopes. They turned up intraday on Friday to show you how indecisive the market currently is, but by the close, they regained a negative slope. So we have a mixed bag here. The faster, shorter-term moving averages are trying to turn up, but they have not done it yet. But we still have a bullish and upward sloping 50-day moving average. You'll note price is still below it. That's part of the mixed bag. And we have a bullish 200-day moving average, which indicates the long-term trend is still relatively healthy. We also have RSI here that still has somewhat of a concerning look. If you're a bull, you would feel better if this RSI moved back above 57 or 58 and started to look more like this. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.